Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another Planning for Life podcast with Russell Jacobs. Today, we are going to go over a number of common finance myths. And I couldn't think of a better person to talk to than Russell since he's been doing this for so long. And these are common things that he hears on a regular basis, not just from clients and prospects, but also people that he runs into who know that he's a financial advisor. So Russell, welcome back to the show.
Thanks, Matt. Happy to be here.
All right. I'm just going to kind of rapid fire these. I have a pretty long list here. So are you ready to just me throw some questions at you?
Guess we're about to find out.
All right. Let's do that. The first question is, it's more of a statement, but it is a question. I'll make less money if I get a raise into a higher tax bracket. Is that true?
Well, it's possibly true if you were just on the cusp of the next bracket and then you got your chin above it from an income standpoint, and then if your marginal rate went up. But with proper planning, that could probably be changed from a yes to a no, increasing your contribution to your 401k or other things like that, perhaps charitable deductions if you meet the requirement. You'd want to check with your tax advisor, of course, because we're not CPAs. But I think that's definitely a maybe instead of a yes or no, because it depends on if you get ahead of it. What we see often with people in tax matters is they don't do tax planning. It's kind of like, I think it was Will Rogers said, there's three kind of people in the world: those that make it happen, those that watch it happen, and those that say what the hell just happened. Which one are you? And I think that a lot of people are like that with life and taxes. And so if you just go into your CPA or you're doing it on TurboTax or whatever, and you just put in the information, at the last minute, it's probably a yes. But if you thoughtfully sit down and look at what does that mean, and then I can do A or B, you can very likely mitigate that potential increase and get more of the increase and enjoy the increase on a net dollar basis.
All right. Speaking of that, renting is a waste of money. Is that a truth or is that a myth?
Well, it really, I think that's, again, a lot of times when we get asked questions, the answer is it depends. Mm-hmm. Because it depends on, what is your goal? What is your purpose? And, when we talk about investments, we talk about time horizon, risk tolerance, need for liquidity, for things like that. I would apply that same metric to rent versus own. Certainly, if you're going to, plant roots somewhere and that's going to become your foundational place of living, you could make a valid argument that you are going to build equity and ultimately outright own the asset that you purchase. Whereas if you're renting, you're paying someone else who owns the property and you're never going to build equity. But some people, are more like hummingbirds. They like the ability to be able to change and move and go whenever without being tied down. And that's all well and good if it fits your goals and dreams, but you certainly don't own or control anything if you rent. But at the same time, after the financial crisis, the need and requirement to have a 20% down payment became much more hard and fast. And for many people, especially younger folks, but not just younger folks, it's hard to come up with that to get that 20% down. So a lot of people, I think, were forced into renting versus choosing to rent. But that said, I think a lot of people like the more freewheeling nature of the ability to rent. So, so I would disagree, I guess, ultimately with that, because it really just depends on the fact pattern and the timeline, especially if you're not going to be somewhere for a long period of time and it's maybe not a high turnover area, meaning easy to sell property. You could be locking yourself in to something that you can't sell, and therefore your asset is locked up. Whereas if you rent, you can just move. And so there's a lot of factors that go into that before you could actually give a proper assessment, if that makes sense.
Let's talk about maybe not being able to have that 20% down. One of the consistent questions that I hear is, I don't have enough to save. How do you attack that, especially when you're talking to parents of kids who, start working with the firm when they don't have a lot of assets, or, people's assets are tied up? How do you handle this? I don't have enough money to save. It doesn't make sense to save. I don't have an emergency fund. Help us with those. Well,
there's a certain economic line in the sand, if you will, where if you make below a certain threshold, I guess I can understand that. But in most cases, people could save money if they really looked hard and fast at where are they spending their money. Because in almost all cases, and as you know, we do a lot of 401k work, so we talk with participants at all levels of the company, from custodian to CEO, and they're spending money, whether it be cigarettes, movies, beer, just any number of things, certain hobbies. And people don't understand the difference between need it and want it and dream to have it. And we get all turned over in our minds that, well, I work hard, I deserve that. Well, we don't deserve anything, really, per se, except to be treated fairly. And there's certain, of course, social and things like that are just, basic rights of life. But other than that, we are a free country who manages our circumstances, and understanding delayed gratification and working towards something that you want, you shouldn't have to buy it, or you shouldn't buy it right away. And so that's what we tend to see more with people who say, I just can't afford to do that. They really could. What they're really saying is, I'd rather spend my money getting my daily Starbucks, or, playing golf, or taking this Disney cruise, or whatever it happens to be, more so than saving it, but that's really a want, not a need. And so I think it's a reassessment of values and priorities is in order. And that is what we work with people to do. We call it sharing the unvarnished truth, which is not always pleasant, but you need to understand that you have to work to achieve that goal, and you're not always going to be able to work. So the younger you start, the easier it is. And/or you need to reassess what you say you hope to have in retirement with a reality check. Switching gears a little bit outside of some of the normal day-to-day things, what about when people say, I should get out of the stock market when the market itself is doing poorly? What do you think about that? Well, again, I think that's emotions over logic. And there's a lot of noise in the news. Pick your medium, whether it's old-fashioned newspaper or alerts you're getting on your phone or watching nightly news. Fear sells, and there's and I won't say the average numbers because they won't be accurate, but there's a number in any index, often the S&P 500, a common stock market index that's used. Just for example's sake, it earns high single or low double digit historic average over a long period of time. But if you apply that same number to what the average investor earns, it's much lower. And that's because people can't emotionally deal with the risk, and meaning there's this phrase, it's time in the market, not timing the market. And it's historically proven if you stay in the market over long periods of time, it has historically advanced favorably. But often people sell it, whatever it is that they're holding, whether it's a mutual fund or a stock, they sell it after it's already gone down in value, and then they buy it back after it's gone up. So they're inherently doing the inverse of what they should be doing, when in reality, if you had a proper risk analysis, understanding your true risk tolerance, meaning not saying you're aggressive and then freaking out when the market drops, but understand your risk tolerance and your time horizon, and the fact that you won't have a need to go access this money on an interim basis, then you can really get into a proper asset allocation, meaning all your eggs aren't in one tight basket. And when you do that, you really are better off just to stay in there. And depending on what type of investment you're in, certainly you have to have buy-sell discipline, meaning people tend to want to hold on to individual stocks because they want to wring that last dollar of gain out of it on the upside, or they tend to hold on to them on the downside because they want to wait for that turnaround because they just can't believe they bought a loser in value. So you have a lot more risk if you do that. But in the end, you have to be able to let things go and not get attached to them emotionally, because it's really, investing is a means to an end. So knowing your goals, and I've said that a lot, goals, time horizon, tolerance for risk and volatility, looking at those things prospectively before you do anything gives you a lot more peace of mind and ability to stay in. And stay in, ultimately, to answer your question, is what you should do. You shouldn't be trying to jump in and jump out of the market, because you have to make two right decisions: get out right and then get back in right.
Sure.
And it's very difficult to do.
What about, I can never have too much cash?
I would disagree with that too, because one of the things that people think is they're being safe by putting their money on the sideline like that. and to a degree that's true. You can't lose actual value from the standpoint of your investment dropping in value because the market went down. But to look at it completely, what you have to understand is there is inflation and there are taxes. And so if you're earning, particularly in a low interest rate environment like we've been in here for a number of years, if you're in that situation, if you factor in, say you're earning 1%, which in some cases you aren't, but if you're earning 1% and inflation's 2%, and you pay taxes at a rate of, say, 20%, and you have state income taxes, you really have lost money in real spending power terms by doing what you thought was safe. And not only that, if you look at historic normal returns in the stock market and bond market over long periods of time, and real estate, pick your asset class, those have historically outperformed cash over longer periods of time. So the answer is, you want to have an amount of cash that's appropriate, but you don't want too much in cash because it's an inefficient asset from an accumulation standpoint.
Well, and isn't it true right now that there's just so much cash sitting on the side?
Yeah, I couldn't tell you the exact number, but both with individuals and corporations, there is quite a bit of cash on the sideline. That is true.
All right. What about having a credit balance will boost your credit score?
Clarify what you mean by that.
Like I need to keep balances on my credit cards in order to increase my credit score.
Well, I think that to a degree, there are a number of characteristics that the ratings agencies look at, but I think it's more paying your credit cards on time than actually carrying a credit balance, because I haven't carried a balance on my credit card in probably decades, but I use them extensively because I get points with American Express and Marriott, and at the gas station, pretty much anywhere I use that card, but I pay them off every month. So, and I have a very high, what they call beacon score, which is how they give you a number. So I don't think so much, in my opinion, it's not keeping a balance. In fact, if anything, that's going to be detrimental to your credit because you may be paying 15 to plus percent interest, and it makes it harder to pay the card off, and you pay a lot more for an item than if you just bought it outright. So I think paying for things on time over a long period of time on a consistent basis is more important than carrying a credit balance.
Now, we're going to switch gears again because I hear this more often than not, which is, well, I don't really need to pay attention to my finances because my spouse or significant other does. Well,
that could be true, but we live in a country with a 50% divorce rate. And I think it was Ronald Reagan that said, trust but verify. I think you need, as the passive spouse, shall we say, in this case, you need to at least have a basic understanding and working knowledge of what's going on in your household. My wife, Cindy, shared with me recently that she has a friend, they're fairly well off, and her husband asked her what she wanted for her birthday. He was the one who did all those details that you were referring to. She said, I don't really need anything, but I'd like to know about all of our finances. And so every year he prepares and updates a report for her so that she's comfortable. If something happened to him, she kind of knows where everything is. And effectively, that's what we do for our clients because, a lot of times you have both spouses working and it's hard to keep up with that. So whenever you decide to get serious about it, whether it's the one spouse or both, and it usually is, there's one spouse that's more, that's their area. If you go through the pain and the work of the exercise of getting yourself organized and you create your baseline of where you are vis-a-vis where you want to be and the blueprint of a financial plan, then you can make that more true because say there's the primary spouse we work with to do a plan. The other spouse is comfortable knowing that everything is organized and okay should something happen. But to use the ostrich approach where you just stick your head in the sand and say, well, my spouse is going to take care of that is very risky in my opinion. It's not a good strategy. A couple of years ago, we finished a financial plan for a very successful business owner and very complex, a lot of entities and things of that nature. When we got the plan done and delivered, his wife actually cried. And he's like, what's the matter? She's like, I'm happy because this is the first time I feel like if something happened to you, I know where everything is. And so whether it's just your basic husband and wife W-2 employees to the most complex, that there is a right to know, and there should be an inherent ability on the part of the surviving spouse in the case of death, or the spouse who's when you get divorced, you should be able to relatively easily know where your things are and that you're going to be okay. So that was a long way of saying that's not a good choice, not having a clue or blaming it on your spouse, because that's the other thing that's going to happen is then if something goes wrong, it's all on them, and that's not fair.
Yeah. All right, my last question for today's podcast is it impossible to know how much I'll need in retirement?
It is impossible to know exactly, but I would say generally the answer is no. That's the whole point of really going deep on what do you want and when do you want it? Because then based on certain assumptions and historic fact patterns, we can build some pretty accurate modeling, factoring in a rate of inflation and a rate of return assumption, and then how much you spend. So you have to know how much you spend. So, it's just like math. If there's too many variables, you can't really solve a problem. Financial planning is no different. But if we can get enough of the boxes checked where we're not guessing because we have enough knowns, then we can build a pretty accurate model. And then what happens is you review it and update it on a regular basis, because whatever plan you build and whatever goals you project and want to accomplish, you do your plan, then life happens and you adjust your plan. So But you can, and then, each year of planning update you do, you have another year of history, and you have a better understanding of what you spend, and you can get pretty accurate with that. And it brings a lot of peace of mind, the organization of it, and the kind of the confidence of knowing that you're moving down the right path. So that's a big, it's very possible to get done. And, it's not impossible to project with some degree of accuracy. I'd venture to even say a high degree of accuracy if you have enough knowns.
Well, what did I miss? Give me one more of the common financial questions that you might get, as you're just hanging around.
Well, I think, in my experience, most people tend to be fairly optimistic, and they think things are going to work out. I mean, how many times have you heard it'll work out? Well, I think that it will. I mean, I'm an optimist by nature, but it will work out, but it has a lot better outcome if you work too. So, I think the more prep you put into it and the more knowledge you give yourself, and if you really look at yourself in the mirror and understand the difference between our family actually needs that or we just want that, and instill some discipline into your spending patterns and saving pattern, it'll be fine. But I think this, and own it, people thinking other people are going to take care of them, whether it's family members, friends, or the government, usually leads to a lesser outcome than they were anticipating. So I guess that's the thing, is take personal responsibility and make a decision. As you know from these previous podcasts that Carl and I have both done, Carl's my partner here at Jacobs Coolidge and Company, it is procrastination. So educate yourself, understand your goals and objectives, and then make a decision. Just don't procrastinate. Because, I just turned 57 this month, and I'm like, wow, how'd that happen? The next thing you know, you're 67. It just goes by so fast.
Well, Russell, you don't look a day over 56.
Thank you so much for that. I was hoping 46.
Well, All right. Well, hey, thanks, man. I really do think that everybody who's listening needs to understand the power of that financial plan. And that's one of the things that Jacobs Coolidge and Company does so well, is sitting down and helping you create that plan, uncover really what you want, what you need, and what your life is going to be like, and asking you the right questions so that you can have that sense of calm, that sense of security, that sense of, I really feel like I know where I'm going. That's super duper powerful, just like the story that Russell told about the woman who was crying at the end of the plan, because now she really truly knows where everything is and what everything is doing.
Yeah, and Matt, if I might just interject too,
Sure.
This is not rocket science. It's a matter of allowing yourself and making yourself work on your future, and not just, in your business day, because we're all busy. We all get pulled in a lot of different directions, but you have to prioritize this. And what we see over and over at all levels of economic success is people spending more time planning their vacations than they do their potentially 20, 30, even 40 years in retirement. Mm-hmm. And they know maybe every baseball, football, golf statistic, whatever it is that they love to do. And they don't know any of the details about their own personal investments or where it's going to come from when they're no longer a person at work. So, but I would just say, look, it's not rocket science, but make it a priority.
Awesome. Well, if you have not subscribed to the podcast, make sure you click that subscribe now button below. That way, every time we come out with a new podcast, will show up directly on your listening device. And finally, if you know somebody who needs to hear about how to overcome or some of these myths that need to be overcome and busted, please make sure that you share the podcast with them. And Russell, if you don't mind, why don't you share your phone number with everybody so they can reach out if they'd like to sit down and chat with you?
Our office number is 912-265-2876. And my cell number is 912-617-4750.
Wonderful.
If you're serious about planning, we're serious about talking to you.
Awesome. Well, thank you very much. And for everybody at Jacobs Coolidge and Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs, Coolidge & Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.